Well, welcome. My name is Kevin Malone. I'm the founder of Greenrock Research, and I'm joined today by Steve Cucchiaro, the founder, chief executive officer, and chief investment officer of Three Edge Asset Management. We're here today to talk about what we're calling a broken bond market and why the Three Edge conservative portfolio is a great substitute for bond allocations. Steve, bond yields are at or near their all-time low, and our clients are questioning what purpose bonds have in their overall allocation. The historical benefits have been higher income than equities and much lower volatility. It doesn't appear that either of these benefits are achieved today. How do you see it?
I agree, Kevin. If you think about it, bond yields peaked back in September of 1981 at an all-time high, over 15%. And they didn't turn around until we had an extraordinary monetary tightening by the Fed. That turned things around, and bond yields came down over a 39-year period. Now we're at the mirror image, the exact opposite situation. As you just alluded to, we have bond yields at all-time record lows in March, in this month. And we've just heard from the Fed where we got an unleashed monetary stimulus plan that's greater than anything that's ever happened. So I see the mirror image, and I think that we have a situation now where, yes, in the last 39 years, bonds had a purpose, safe source of income. You could lock in a higher rate, and as interest rates came down, your bond principal appreciated. Now, those days are over. And just one reminder, if you own a bond that has a 10-year duration at these low interest rates, you're not only earning very little income, but at a 10-year duration, 1% interest rate hike equals a 10% decline in the value of that bond.
Right. So your conservative portfolio was our answer for a bond substitute. Returns are always difficult to predict, but reduction of volatility and limited drawdowns have always been consistent. So tell us about the conservative portfolio and why it might be the right idea for this dilemma over the next 3 to 5 years.
Well, the original idea behind conservative was to construct a portfolio that could withstand the widest variety of economic and market conditions with sharply reduced volatility and drawdown. And we've stress tested this portfolio strategy over the last 140 years. We've analyzed every bear market since the late 1800s, and we've learned a lot from that. And what we learned was that, yes, there are certain environments and conditions where bonds can be that safe source of income and that good hedge, but there are plenty of times when bonds fail at that and other assets act as a better hedge. So we wanted a strategy that could be flexible and use the right hedge that's matched with the right conditions. In a period that we've had over the last 39 years, which is when most money managers have been in business, we've had falling interest rates and falling inflation, and that's when you can create real or inflation-adjusted wealth by owning bonds. Other periods, like from the mid-40s to the early 80s, just the opposite. You actually lost wealth owning bonds, especially against inflation, and especially during the 1970s as an example. Now, another kind of period is what we call the credit contraction. And that can either happen like we had in the early 80s when monetary tightening is so strong that everything goes down except cash, and cash is your safe investment. Or like earlier in March, when the market plunged, we had a rush to deleverage, a rush to cash, and everything went down except cash. So there's a point in time where cash is your best hedge. And by cash, I mean short-term treasuries. Another period that happens from time to time is when you have extraordinary monetary stimulus. You can get negative real rates, meaning inflation adjusted. You can get weakening currency. You can get inflation. You might get all three. And in these environments, gold is the best hedge. We saw in the 1970s, when stocks got hurt, when bonds got hurt, gold was by far the best hedge, and owning a bit of gold greatly helped offset losses in equities. We also saw that in the 2000s. Gold was the best performer. And we think now, given the what you might call QE infinity, this extraordinary fuel, monetary fuel that the Fed has created, where they basically said the limit of money printing is unlimited. We think that's going to be good for gold. Now, there's one other environment where you have a bull market where sometimes all of these various hedges fail to make money.
Right.
And equities can do well. Now, because we're trying to minimize volatility and drawdown, we would only allow a certain capped limited amount in equities. But by being able to be flexible and match the hedges and match the investments with the environment, we think we can do a lot better than just being stuck with one asset class like bonds.
Right. So you will be able to protect assets as long as we're in this difficult period. At some point in time, you'll be able to use a little bit of risky assets that may improve returns. And my comment about returns are difficult to predict. As markets come down, it's going to be difficult for anyone to make returns. But there will be a day, and that's why we think about this over a 3 or 5 year period of time. There will come a day when you may get reasonable returns, maybe outsized relative to the volatility that you get by investing in real estate or in equities. And that's the thing we love about the portfolio, is it's not stuck with one asset class, and the bond asset class right now, while it worked brilliantly for a long period of time, is just a broken asset class.
Yeah, we would agree with that. And as students of market history, we gained a lot of perspective by looking outside this incredible bull market for bonds like the world has never seen. We know those days are over. So we think it's especially important for people to be flexible and be thinking flexibly.
Yeah. So you and I have worked together for about 15 years in the various firms that you've had, and we actually have a track record going back 20 years for this whole idea. And so I appreciate the opportunity just to show this to our clients and perhaps to their clients. I want to thank you for participating. If anyone is interested in more information about the conservative portfolio, they can either email me at kevin@greenrockresearch.com or call me at 312-463-1301. So Steve, stay healthy. I'm glad to hear everybody at 3 Edge is doing fine, and we'll get through this. I'm always reminding our clients that what we're going through today will be part of our history at some point in time, and we'll be back in offices and traveling and everything. So thank you very much for your time today.
Thank you, Kevin, and best to you and all of your clients and your family.
Thanks.